Welcome, my name is James Barber, your Oregon Cash Flow Pro. What a day in the market yesterday. Man, Nvidia down 4%, Meta down 1.62. Look at all these charts, they're gonna look very similar. Google down 2.71, Amazon down 2.83. All of this adds up to a triple Q that was down 2%. That caused us a little bit of problems in some of our trades. So in this video, we're going to be covering a lot of stuff. So stick around if you're interested in any of this. We're going to update our Nvidia poor man's covered call. We thought we were set and in position for earnings, but this market drop gave us a big opportunity. We're back in it, baby. I'm going to update you on that one. The drop in triple Q caused somebody to exercise a put option early, which caused me a little bit of a headache, but not too much because the broker that we use is great. And I'm going to show you how we handle that. And I'm going to show you the trade that it was with, which I hadn't disclosed previously on this channel. We can't win them all, and we're most likely not going to be winning that one. But let's see how we were affected by the early exercise. I'm going to update you on our BROS long put position, and we're going to finish it off with our QDTE update with regard to our infinite banking loan, investing $10,000 into QDTE. So stick around, this is a jam-packed episode. Let's jump into it. Let's kick this off with the Nvidia update. Up in the corner, every time I get to one of these trades that we've done previous videos on, I'm gonna link the video so you can see what happened last time. Because I'm just gonna give you a brief recap of our goals in this one and why we did what we did. So we originally started out with a 2-year long call, deep in the money, 85 strike price. We sold some covered calls. We originally got into this when Nvidia dropped substantially. Our goal, sell a bunch of covered calls as long as possible, maybe for 2 years. Odds are though, Nvidia at some point is gonna outrun our strike price and we deal with it at that point. Sure enough, Nvidia did outrun our strike price here and we had to roll, and then we had to roll again, and then we had to roll again. And ultimately, this roll was in the last video where we rolled it out to the 95 strike, 10 strike prices up from this one, same expiration, effectively closing our position for what was over $500 in gain with an additional $600 in gain with this open spread that will produce another $400 in profit at expiration in 2 years. Not bad overall. We were up $1,000 with another $400 to come, but that was going to be a bit of a wait. But it did free up our capital, so we could go do something else. The plan was sit on this position. If at earnings Nvidia drops, we could buy this back and get back into selling covered calls. Well, when we did this roll here, Nvidia had really ran through our strike price, and we were kind of going up as far as we could while still getting a credit. So we weren't in a position to roll it anymore, but we had substantial profits. So we weren't too concerned about that position. That's why we effectively closed it. Well, the drop for Nvidia today gave us an opportunity. We made about $500 by buying this one back, and we were able to sell the 140 strike for $400 right before close. Now, this puts us in a position that's 8 strike prices better than we were before. At this point, we were minus 953, not counting the extra that we collected here. We were at 500 in profits, remember. Originally spent $5,420. But let's see where that leaves us now. With all of those trades, we were basically in a position that our original break even was the 139 strike price if we went the full 2 years, or we got exercised early. We were at the 132. There was some serious risk that we would get exercised early. That's why we ended up rolling that one, because the extrinsic value left in that option was almost nothing. And Nvidia didn't look like it was going to be slowing down. Turns out it did slow down. Even if it hadn't, once we moved to this position, we were safe. Gains locked in. The opportunity that arose, however, was the ability to buy this back. Now, ultimately, between these trades here, that wasn't a gain, but we did manage to get an option that expires this next week, right after earnings. That's 8 strike prices higher, and we get $400 for that. So ultimately, if Nvidia goes up at earnings, we can do the same thing we did before, If it's something that we can't roll out and collect premiums each week, so it means if it shoots up too far, we move back to this one and we probably sell it for quite a bit higher. Should be $800 or $900 higher. If, however, Nvidia doesn't end up above that, this expires worthless and we get to continue selling calls for potentially the next 2 years until the expiration date of the original one that we sold. Now you can see this is where our position is at right now. Remember, we were up $500 and we had 600 locked in on the spread that we had, the vertical spread, expiring in 2 years with a potential for another $400 profit with a small risk that Nvidia in 2 years ends below $85 and we lose that 600. So we basically had $500 locked in profit. Well, we're in a position right now where we're only at 300 locked in profit, but we've got this call sold at the 140 and our original one is still up $1,000. So we're in a really good position with what ended up happening here and buying this back, even though we're no longer showing that we're at $500 locked in profit right here. We're at 300 less than what we originally paid for this, and this is currently worth about $6,500. So all in all, we're in a much better position after that quick drop in the market. We're looking to make some good income again. If you want to follow along with this, I'm going to be reporting on it basically every week, trying to provide a learning opportunity for you folks to see how options get used to generate some consistent income. Switching over to BROS. BROS, okay, the last update I did on this was right before earnings. BROS at earnings caused all kinds of problems. We were in a long put position. We had that 55 strike. Ultimately, we were hoping to see BROS go down at some point over the next 2 years, and we were just going to sell. We only have an opportunity to sell monthly calls, so it's not great, but I'm basically just trying to get something as I buy time. Well, somebody liked what they saw at earnings, and BROS shot up to $80 plus, and we ended up buying back this call that we sold for pennies, and then I rolled this one up. We closed it and we rolled it up to the $80 strike price. So I could have just taken the loss. Right when it moved up, I could have just taken the loss. It was a loss of $700, but we don't want to do that. Why do we need to take a loss on this? We don't need to take a loss on this. Not yet. So we rolled it up. Ultimately, it put us in a position that was this minus another $1,800. We only got 700 credit for this one. It was a loss of 50% on this one. So we're at a cost basis of negative $2,500. We were patient. We didn't sell the put right away. We didn't sell another put right away. We were giving it a chance to come back down, and that happened yesterday. So BROS lost quite a bit yesterday. We were able to sell this call at the 70 strike, bringing us into a position at minus 2410. Now, where we're sitting at currently, this option is worth about $2,100. So we're still about $300 negative, but we got 2 years on this thing. And if BROS drops down to this 70, this becomes profitable. Now we have a month till expiration, so we're not going to be doing much with this. We don't anticipate doing much with this. I may play some movements on BROS though. If BROS goes back up, this goes down. I probably don't wait for it to expire. I'll probably look for an opportunity to buy it back and then sell it again later in the month if it drops again. We'll see. I just hate waiting a whole month for these things. I do not like monthly expirations, but that's where we're at. So that's the play with this one. This is like a poor man's covered call, but it's a poor man's covered put is ultimately what this position is. I wouldn't cover it at all if I thought for sure in the near term, like before this expiration, BROS was just going to keep dropping. It might, but we would be a little bit more patient. I have no idea what the market's going to do over the next month. So we're locking this in, knowing that if it does get to the 70, we're going to be profitable on this one and everything will be okay. We could roll that out to another month, or we can just close it for a profit at that point. That's the plan with BROS. Quick update on GME. GME, we are just sitting uncovered waiting. Couple of times GME shot back up over $27 and then it came back down. So we're just sitting in a position that's, we need to sell the call that we have for over $1,074 to make a profit. Now I've got a year until expiration on this, 11 months. I'm not in a rush here. And ultimately I need a break even of about $31, but it's not worth very much. So there was a couple of times I could have sold the 30 strike price for $30 and I just opted not to because everything feels like it could really shoot up at any point. There was one point where GME shot up over 28 bucks when the market was not open. It was pre-market or aftermarket, and then it came back down. So we didn't get the opportunity to do anything at that point, but it's coming. It's coming. And there's rumors that GME is getting into crypto, maybe buying some Bitcoin with all the cash that they have. We'll see what happens. But this one could pop at any moment. I don't want to be locked in at the $30 strike for a measly 20 bucks and miss out on it. So normally I would try to just chip away at this, but we're going to be patient with this one also. Okay, update on QDTE, and then we're going to move on to the exercised put that caused us some headaches and how you deal with that. Remember, QDTE, we put $10,000 into QDTE. It bought us 251 shares. This was back on January 29th. January 29th, now QDTE tracks NDX. This was the value of NDX on the 29th. This is the value of NDX today. This is the current price of the shares after today's drop. So this is our current value, but we've received some dividends. So this is where QDTE is at in relation to NDX without accounting for the dividends. And then accounting for the dividends, we're up. And remember, this is the reason that we're in QDTE. Well, there's two reasons. One, it kicks off tax-free dividends that we can repay the loan with. At the end, it should take about 3 years. We'll have this loan paid back, and we'll still be sitting on 251 shares that will continue to produce dividends year after year. That's the goal here with this. We're using a little bit of leverage. This is infinite banking in practice. And if you're not sure what I'm talking about with infinite banking, do a search for that on my channel. I've got a lot of really good videos on it. Here's the dividend payouts we've received so far. 1, 2, 3. We've gotten 4 for a value of $230.05. Total dividend payout so far, 92 cents. And we haven't even gone 1 full month. Not too shabby. These are the dividend payouts as a percentage if we annualize it. And this was the dividend payout just based on the original investment for that week. What do we do with these dividends? We put them towards the loan. So here we're tracking the loan. This is a loan at 5% interest that we took from our life insurance. This is cash value that we're just sitting on in our life insurance. And when we take a loan from it, it doesn't stop the growth and compounding in our life insurance. This is the essence of infinite banking. We've got our money working in 2 places at once now. It's still growing and compounding in our life insurance, and now it bought a cash flowing asset. This cash flowing asset is going to kick off dividends. That's going to pay back the loan. And at the end, we've got money back in our life insurance that we can redeploy into another investment. And we still have shares of QDTE kicking off income every week. So QDTE kicks off a dividend. We pull that money out of the account and we send it back to the loan. You can see here, each week we make that payment as soon as it comes in. So where we're at right now, our loan balance is $9,804. It was $10,000. QDTE that we originally purchased was valued at $9,977. Its current value, $9,904. We're up a bit on the overall trade, even accounting for the drop that happened. So the value of our shares is still worth more by almost $100. Hasn't even been a month yet. And we just had a 2% drop on the day, a little over 2% drop on the day on this underlying index. Now, prior to that, we were at like 10,300 in total value here. This was over 10,000 and our loan balance was at 9,800. So we took a bit of a hit with the market drop, but we're not concerned about it. It actually doesn't matter that much what's going to happen in the market, as long as this can continue kicking off dividends that will repay that loan. Because remember, at the end of this, when we pay that loan back, we'll still have these shares. It's not likely that NDX is going to be worth $0 at any point in the near future. So these will be worth something at that point. Hopefully, they'll be worth more than the 10,000 that we started with. That's ultimately the goal, right? That brings you up to speed on QDTE. Now let's get into the trade that I hadn't revealed before on this channel. I was testing out a strategy and I kind of like what it's doing. We ran into a hiccup, but it's not the end of the world. Here's what we've got going on. I put this trade on the 13th of February. This is a calendar spread where we buy the 538 strike price, we buy a call and we buy a put expiring March 7th, and we sell calls and puts each day. This is on triple Q. There's a daily expiration. So the thought is, let's harvest some of that theta. Now there's some risk to it. There's some delta and gamma risk going on with this. And that's ultimately where the major risk is at with this type of a trade. It had been working out pretty good though. We were in a position that was not too bad. It actually would have been really good. We were almost profitable from selling the calls and the puts each day before the big drop in the market. The big drop in the market put a lot of pressure on the call side of this, where I'm not going to be able to get much premium, and it created the risk of getting exercised. We shouldn't have been exercised, but we did happen to get exercised. And I'm not sure why. We still had a day till expiration on the put that was exercised, and it still had some extrinsic value. It wasn't very much, and probably on Monday, the extrinsic value would be at 0. So that might be why they exercised it. The position it put us in is we now own 100 shares of triple Q at the 538 strike price. Currently, those are worth $52,595, representing a loss of $1,200. And when we calculate where everything is currently at, except for the value of our call option, we're going to be down $436. Now, when the market opens, my expectation is this put that I'm going to end up having to sell is probably going to be worth a little bit less. So expect that this is an even greater loss. Not by very much, but it'll be a little bit bigger than what we see here. Depending on what triple Q does at market open, if it's up, we're going to be in a better position. If it's down, we're going to be in a worse position. If it's up, we're in a better position two ways. One, I'm going to be able to sell these shares for more than this value. This loss gets smaller. Two, the value of this put moves a little bit slower than the shares. So while this gets smaller, the profit on this one gets smaller, but not as quickly. So we get a little bit of a spread there between those two. And then this one, my call goes up in value. This call is currently worth like $287. So our overall position is now effectively negative about $150, $160. Likely to be a little bit more than that on Monday at open. But we still have 10 trading days to potentially chip away at that and give the market a chance to reverse, and we make more money on this call option. I could just keep this put option as well. I don't have to sell that. I can just close the shares. We'll lock in this loss and let the put ride it out. Because if the market continues to drop, we're going to be in a pretty good position hanging on to this put. That put will get more valuable faster than this call loses value. So most likely, that's what we're going to end up doing. We're just going to sell the shares when the market opens, and we'll see if we can chip away at this $436. This is what it looks like in Tasty Trade when you get assigned. Somebody exercised their put, we got assigned, now it shows up as 100 shares right here. Tasty Trade handles this in a great way. Not all brokers will handle this the same way, but because I have enough value in my account, doesn't have to be a whole lot. Remember, my loss represents about $1,000. I have a lot more money in this account than $1,000. So they're not concerned about letting me sit on these shares and sell them during the next trading day. This does two things for me. I can decide if I want to sell them at open or wait for the market to move. My loss could get greater or it could get smaller, just simply from waiting on that. But the second reason is the put that I have that was covering that one. This is my long put, expiring in 13 days. It's 10 trading days. It has some extrinsic value still, which means if they let me sell this put, I will have more money in my account than if they just exercised this put for me in order to offset the other 100 shares. Now, if I did not have enough money in my account to cover the risk that those 100 shares that got assigned to me are already negative $1,200, they would have had to exercise this at the same time because no brokerage wants to take on the risk that you're just going to sit on these shares and continue to bleed money that you don't have available in your account. And they're going to have to start closing your positions. Some brokerage firms will do that automatically. They'll just close the covered position and you don't get the opportunity to take the profits that you otherwise would have had. So it could be extra bad if you get an early assignment. That happened to me when I was in Robinhood before. I had Robinhood, I got an early assignment, and they just triggered my other option. I didn't get the opportunity to sell it, and I missed out on a few $100s in profits. Kind of sucked. So just be careful. if you're doing trades like this, know what your brokerage does if you get early assigned, and clearly do whatever you can to not get early assigned. Usually I will be looking at what's the extrinsic value left in that option. If there's a substantial amount of extrinsic value, the odds of it getting exercised are very low. If there's extrinsic value, whoever owns that option is better off just selling it, getting the cash and the extrinsic value. But sometimes people do dumb stuff and we end up in a situation like this. Now, the extrinsic value was probably 0 because the market dropped so much on Friday. So this wasn't as bad of a move as it could have been, or as I've seen in the past and been subjected to. This one kind of makes sense. I almost exited the position, both of them, before the close of market because I didn't want to get exercised. But Tasty Trade handles it pretty well. They send you an email with a link to a very nice video that explains in a calm manner, don't panic, this is how you manage the position. They also send you this one, which says there's a Reg T call, it results in a liquidation strike, it's satisfied via liquidation, and then it warns you, multiple liquidation strikes within a rolling calendar year will result in the following. 1 to 3 liquidation strikes, it's just a strike issued. But if you get 4 or more, your account's going to be set to closed positions only. So you don't want that to happen. And then notice this, liquidations that occur on the day following an exercise or assignment will not be issued a liquidation strike. So what happened to me, as long as I close that position, I sell those shares on the day following the assignment, I won't get issued a strike. So how this was handled ultimately was pretty great. We're not too concerned about it. We still have the opportunity to profit from this trade. If you're interested in following along in these, learning more about options and getting better at managing that cash flow, subscribe, hit that like button, follow along. I appreciate you guys joining us for this. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.